So you're writing your business plan and you finally got into the last section, the exit strategy. But now you're lost because you haven't even entered the market yet with your product or service and you're already talking about exiting. Well, if you're looking to raise investor funds, the exit strategy definitely matters. And to some investors, it's the only thing that matters. When it comes to exiting a startup, there are several strategies that you can consider. And in this video, I'm going to walk you through each one of them. Investing in a startup is like buying a boat. The two most exciting days are the day that you buy it and the day that you sell it. An exit strategy defines the business's strategic plan for eventually liquidating their position, and if it's done right, it allows them to earn a substantial profit. You might have an 80-page business plan that explains every single detail of how you will build and operate your business, but for an investor, all of that is just an explanation of how you would get to this point, the exit. So if you're ready to learn about exit strategies so you can produce a business plan that engages investors, then grab a swimsuit, an oxygen tank, and some flippers because we're about to dive deep. Let's get it. In general, there are 5 ways that a founder can exit a business, and we're going to talk about all of them and discuss the best time to consider each of them. So let's get started. Most startups hope to exit by merger or acquisition. This happens when a startup shows extreme promise, like they've seriously disrupted the market, they've generated a ton of customer interest, or they created an amazing technology and now a larger company makes a deal to buy them out. The company might want to buy them out to eliminate the competition, or they might want to assume their customers, or they might want to have uninterrupted access to the team or technology. There's a difference between a merger and an acquisition though. In a merger, 2 firms combine, forming a new legal entity under one corporate name. An acquisition happens when one company purchases another company. Some of the most significant mergers I've seen in my lifetime include T-Mobile and Sprint, Heinz and Kraft, and Disney and Pixar. And we hear about new acquisitions almost every day, but some of the most profitable acquisitions over the last few years include Google acquiring Fitbit for $2.1 billion, Apple purchasing Beats by Dre for $3 billion, and Intuit acquiring Credit Karma for $7.1 billion. Imagine being one of Credit Karma's early investors and being a part of that exit. An IPO or initial public offering happens when a company offers shares of their private corporation to the public. In the media, an IPO is what happens when a business announces that they are going public. When a successful startup or established business goes public, the company's IPO becomes an owned and publicly traded entity. Going public always sounds like the most attractive option, but this really isn't the case. Actually, it's a challenging and time-consuming process that most companies can't navigate on their own. According to the National Venture Capital Association, only 16% of venture-backed startups recently used this alternative due to high liability concerns, demanding shareholders, and high costs. To go public, a private company needs to prepare themselves fully for the numerous steps that are required. During the process, they'll face more public scrutiny than they're used to, and they'll need to file piles and piles of paperwork and fill out a bunch of disclosures to meet the requirements of the Securities and Exchange Commission. Usually, businesses will seek the services of an underwriter, like an investment bank, to advise them through the process and help them assign an initial price. Regardless of the difficulty of doing so, an IPO is still a viable exit option for some businesses. However, even in the best circumstances, it's probably the option that's least likely to happen, so consider it carefully as you write it as your exit strategy in your business plan. Startups can also launch a private offering of their shares to individuals or investors. Since this isn't an IPO, the offerings don't need to be registered with the SEC, making it significantly easier to complete. With this strategy, founders can select investors who share a similar vision, or even bring on experienced individuals who can help them on the strategic side. Technically, this strategy still allows companies to raise funds from the public, but this time it's just a portion of the public that qualifies as accredited investors. This means that they have a net worth of over $1 million, or they bring in over $200,000 in individual annual income. This ensures that each investor is sophisticated and recognizes the risks involved in investing in a venture, which minimizes fraud and reduces the chances of less capitalized individuals gambling their entire nest egg on a startup investment opportunity. This doesn't have to involve individuals at all, but it can also refer to having a portion or the entire business bought out by a private equity firm. Exit by private offering is a common strategy for successful startups, and is one that can provide investors with a significant return on investment. This is less of an exit strategy and more of a strategy for holding off on an exit, because so much cash is coming in that it just makes more sense to keep milking the cash flow. If the business is extremely stable, the team may choose not to exit, but instead to make the business its cash cow. In this scenario, they keep the business open, but they may employ a new CEO or bring in new managers to run the business, which frees up their time and provides them with the funds they need to work on other ventures. Sometimes you'll hear of founders positioned as the CEO stepping down, and this isn't always because of something bad. Sometimes they just simply reach their ideal situation and now they want to move on to new things. The term cash cow comes from the dairy farm, where the cow continues producing milk throughout its entire life with little effort from the farmer. In business, it applies to those that are similarly low maintenance. They don't require a ton of investment and they provide consistent and positive cash flow. Businesses that fit this description are typically low risk and high reward. The cash cow could be the business itself or just a specific area of the business. For example, Apple has the iPhone, which is its cash cow. They'll continue selling their smartphones into the future with little interference and little effort when compared to what it required for them to make previous versions. And as is the case, they can focus their attention on growing other parts of their business and introducing new products to further progress the brand's profits. Liquidation is the exit strategy that you hope never happens, and it's definitely not the one that you want to predict in your business plan. Typically, this method is reserved for failed businesses that now must sell off all of their assets to try and minimize their loss. The liquidation value of the assets is given to the creditors and investors. Creditors get their cut first, and then investors get whatever's left over. Liquidation is the simplest exit. The business simply just stops and the assets are forfeited to the people who you owe money to. Although liquidations happen often, they definitely have consequences. The business no longer exists, employees lose their jobs, founders walk away with very little money, if any at all, and their business reputations take a major hit. While founders might hope to exit in a more profitable manner, liquidations are rather common. Very few people or entities are willing to invest in a failing startup, so when the business reaches the end of the line, liquidation may be the only exit option that's left. Business plans usually have an exit strategy, but the truth is, in the beginning, an exit strategy holds very little weight. It's impossible to know from the first day whether your business will end in a wildly profitable acquisition or liquidation due to failure. However, investors want to know that you have a strategy in place that allows them to recoup their investment and earn a significant return. It's kind of like taking a trip. You have to know the destination before you can choose the best route to get there. Your exit strategy will depend on several factors, including your business structure, the business model, its intended size, profitability, and competition. Furthermore, you should consider your goals. Like, are you planning to stay in the business, or would you prefer to walk away one day so you can take advantage of other opportunities? An IPO, for instance, would allow you to remain working in the business as a large equity owner, while a total acquisition may eliminate or greatly reduce your ownership interest in the company. There's not really a right answer for what you should choose as your exit strategy when writing your business plan, but there are certainly wrong answers. If you choose IPO for your strategy, for example, then your launch and growth strategies need to show how you will eventually reach that goal. Investors know that the likelihood that you will exit by acquisition or IPO is pretty low, just like they know that your financial projections won't be totally accurate. But it will make them more comfortable knowing that you're already thinking of how you will one day make the move to generate an incredible return on their investment. The exit strategy is important, but it's only one of the necessary steps in creating a business plan. If you need help writing an amazing business plan that engages investors, I'll leave an awesome template down in the description below that we've used to write over 500 business plans and help raise tens of millions of dollars in funding for our clients. And as always, if you need help with your plan, I'll link the ThinkLions website below so you can reach out to us directly. I hope you enjoyed this video, and I'll see you in the next one.